everybody, and welcome to the EcoInvestment update for Sunday, December 6th, 2015. And we're a couple days early because I am on my way to Las Vegas. The last couple uploads, we've talked about the possibility. Of course, it seems almost like simplistic to say, well, the market will go up or the market will go down. But we've sort of discovered that through history, rising interest rates are generally the thing that brings market down. But this time around, we had the additional wild card of the Federal Reserve being involved with QEs, quantitative easings, one, two, three, four. So in history, we had no real basis to compare what might come of that. In other words, the market could very well have collapsed under the weight of that QE that wasn't effective and had some type of inflationary spike or something like that. But it seems more likely now my original thesis that rising interest rates are the only thing that can kill a bull market, no matter what the commodity is, be it stocks, be it bonds, be it gold or runaway bull market. It always is something that pricks the bubble, that makes money or the assets to keep playing the game a little more dear to find and to have and to pay the rental on using that to procure more of whatever's in the bull market. Well, we had the same thing last week. We had this week we had the wild trading action of a couple down days, and then we had a big spike up on Friday on the jobs report. Now, interestingly enough, the Fed talks about being poised to raise interest rates, and it's probably looking at about 0.25% raise, if that, if they even do that, because they're still very nervous about the shape of the world out here, and certainly the shape of like Christmas retailing and other job growth. We've had a very slight uptick in the labor participation. It's kind of a mixed message going on here in the market for being, well, let's say 7 years, 6 years into recovery. We're still pretty feeble in here, and the Fed is still awful nervous. So they don't want to be the ones to get nailed with the ones that cause the drop. So what I want to talk about now is the possibilities of melt up. And people have said, okay, suppose stocks go on this runaway bull market, which is entirely possible. Remember, we've stepped out of the market at about this level 4 months ago, so we haven't missed anything, nor have we gained anything. It's like we've been treading water, and we decided to make the market prove itself by having the Dow Jones Industrial Average go up to a new all-time high. Now, if it can do that and close convincingly higher on good volume, then I will wait for the next moderate pullback and jump aboard, expecting that it's going to take 2, 3, 4, 5, 6, maybe interest rate hikes to bring this market to its knees, and that could take a year. Okay, I mean, we could be like 1928. Remember, guys, a couple months ago, I did that 1928 again. I mean, it can cut two ways. We can still be in that period where we got one more glorious year ahead of us, and it's looking more and more like that might be the case. So we want to hold fire here, and we don't worry about not being in the market and biding our time and being patient, because there's still the chance, guys, because the Federal Reserve was up to its elbows in manipulations with this whole recovery and this whole market, all this quantitative easing. There's still a chance the trapdoor could open and everything goes south in a real mega hurry. So we want to be patient. Good traders have patience in abundance. They don't need to front run things. Well, you know, if I jump aboard now, I won't lose out on 700 points. Well, you might not lose out on 5 or 8,000 points either on the downside. And on the upside, if we're going to do a sort of a breakaway market here, there could be thousands and thousands and thousands of points up on the upside. Pick a number when it comes to a bull market, and then make it a very big number on top of that, and the market will probably still exceed that when all is said and done. So we want to be patient here. In the meantime, if you're holding long bond positions or you have mutual funds that have very long bond exposure, 20, 10 years, 20 years, be very careful on them. Okay, you want to come in short. All the raising is going to be on the short end of the curve. The 3 month, the 6 month, the 1 year, 1 year bills and notes and stuff. That's where the raising is going to be. So beware. Don't get caught out there and possibly get whipped on the other end with long-term rates possibly spiking up on you too. Okay, be smart. Make the adjustment while you can. You don't want to be there when everybody heads for the bond exit at one time. It's going to be a very tiny door. On the other side of the coin, remember China was the IMF has now accepted China to be one of the currencies to build its basket of benchmark currencies in the world. This is a big thing. Okay, they're not ringing a bell out there, but you can imagine, given the relative size of China's economy and given the relatively little bit of yuan that floats in the world, you can sort of picture a situation where the world needs a lot of yuan, not only for trading purposes and investing, but also for speculating on the currencies too. So it's going to be very interesting to see if the yuan continues on its trajectory of upward that it's been on in the last 5 years. Stay tuned. Big doings on that front and a big seismic shift in world economies passed with nary a notice this week. So stay tuned. We'll see you in 2 weeks just before Christmas time. So have a good one and good luck, everybody. And your comments are appreciated and thumbs up are most appreciated too. Thanks so much for watching.